Hi, I'm John Tunison, CFO of Soluna Holdings, and I'd like to share with you our 2025 earnings power presentation. Before I get started, as always, I want to remind you of a few details. The following content is completely qualified by the legal disclosures on the slide following this one. Our goal, as always, is to share with you some of our strategic thinking and financial analysis that we're using to guide and grow our business. This content is in line with our principles of being accountable and transparent with shareholders. And of course, we operate in a hyperdynamic economic environment. That's really just a fancy way of saying that things can and do change quickly. And what we're telling you here is based on our estimates and assumptions, which are our best guess at the time. And we reserve the right to revise our point of view based on new information and based on changes in the business environment. Despite an uncertain, dynamic environment, we have to plan and make operating and investment decisions. And this presentation is really designed to lay some of that out for you to review and understand. So without further ado, let me jump in. I'm first going to cover some overview information about the company. Then I'm going to dive into earnings power, which really is our way of showing you with the illustrative examples sort of how we could see our profitability evolving over time. It helps you to understand certain phasing of project development, what that might result in terms of economics. We're also going to show you something new this year, which is not just the project consolidated economics, but we're going to try to give you a view of what, with a certain set of assumptions, the Soluna portion of that would be. I'll follow up with some details about the actual assumptions that went into the modeling for this. And then I'll remind you at the end, but in the downloadable presentation, you'll also be able to see various content that we've included that's also included in our investor presentation. And I highly recommend that you also listen to the recording and download that presentation. There's a lot of good information in there. So let me get started. Again, for many, you already know who we are and what we do, but for those that may be seeing this for the first time, I wanted to review what is Soluna. So, and why do we do what we do? So, AI is the fastest growing technology today. I think everybody could probably align on that. And it is showing exponential demand growth for compute, okay? And along with that is the insatiable demand for power and data center availability. There's just not enough power to fuel that demand. There are not enough data centers. I just recently watched an interview with Sam Altman where he underscored this again, and all of the key leaders in this space are telling you they need more data centers, they need more compute, and the bottleneck for them is power. Now, Bitcoin mining is also very in need of power. And what you're seeing in the industry is consolidation into fewer, larger mining companies. And they want scalable, well-managed, sized up, cost-advantaged hosting partners. That's how they can become most efficient and mine the Bitcoin that they want to mine, over the long haul through the cycles. Now, clean energy also has an issue. It's called curtailment. We call it wasted energy. When a renewable power asset isn't able to provide power to the grid because the grid doesn't want the power, but yet that asset could generate power, that's a problem. That hurts the profitability of the asset, and it's literally power that could be available to use that's going to waste. And so we think that there's a solution in there. And that's where we come in to bridge that gap. We can unlock that stranded renewable power. We can take all of the curtailed power from a renewable power asset and turn it into scalable computing power to solve the other two problems. So what we do is we co-locate data centers. This has predominantly been Bitcoin data centers, and in the future will also include AI and HPC data centers. But we locate behind the meter so that we can take advantage of that curtailed energy, but yet retain the flexibility of drawing energy back from the grid as well. And by doing this, we're actually able to dramatically accelerate the typical timeline. If you wanted to greenfield a data center project and connect it to the grid, we're seeing operators waiting 3, 4, 5 or more years to get that. And we're able to shortcut that down to 1 to 2 years, which is a significant advantage. So again, our mission, we want renewable energy to be a global superpower. We want to fuel the demand in compute and use that as a catalyst to do that. We develop and operate and are predominantly a digital infrastructure company. And we call this convergence and this putting together of multiple problems, renewable computing, and that's what we're all about. So what are we focused on in 2025? Well, we try to keep it pretty simple. There's 4 key things that we're doing. Developing AI, I just talked about a lot of the reasons why we want to do that, and we're focused on continuing to build towards our first AI HPC data center project, and that predominantly involves, 1, continuing to progress Kati, which we think will be our first AI HPC data center project, but most importantly, also developing the right partnerships and joint venture, both from a financing as well as an operating and constructing partner landscape. We're also focused on optimizing projects. We continuously look for opportunities, both in our new builds, but also in our existing operations to improve and continue to be and remain the hosting operator of choice at our data centers. We also are heavily involved in capital formation to bring these projects to fruition and to grow the company. We need strategic capital to deploy, both to build the projects, but also for Soluna to own a substantial percentage of those projects. And based on our track record now of operating, we've demonstrated these projects are valuable. They throw off high quality cash flows. And that is showing itself in our success recently and our continued expected success at attracting high quality capital to enable us to continue to grow. And growing our pipeline is a key focus. So there's a timeline between we find a project that might have a curtailment problem and could turn into a data center project to we've got exclusivity on the project and we're moving it into development. So we focus on finding those sources of curtailed energy, engaging with those power producers, and moving to the point where we have LOIs and then exclusivity on those projects. And when we do that, it goes into our pipeline. And you can see some of our online materials. Our investor presentation can lay out kind of some of the dynamics of our pipeline. It's currently 2.8 gigawatts and growing. So first I want to show you, and this slide is also in our investor presentation, this is our expected potential rate of growth of the number of megawatts that are under management. And then I'm showing you if all those megawatts were to convert into Bitcoin hosted or proprietary capacity, what would that represent in terms of hash rate or exahash? And so as you can see, we've gone from 25 megawatts in 2023, that would be Project Sophie, to 75 megawatts, that's Sophie plus D1A or Dorothy 1A and Dorothy 1B, to expecting to end this year with Dorothy 2 fully energized, and then we progressively energize additional projects, obviously Kati, and then future projects. We've announced a number of them, Rosa, Ellen, Hetty, Annie, and those are the projects that we will continue to push towards development and then construct. So you can see it's not exactly doubling, but we're pretty close to, and in the future years, exceeding doubling of our megawatts under management. That's a critical component of our strategy. And you can see that the efficiency and the hash rate is also moving up. And this is a reflection of industry trends and our view of how that will progress. We think that, it'll go from about 25 joules per terahash is where we're seeing things today, down to about 15 joules per terahash, meaning you get more compute power for the megawatts of energy, which is good for us. It's good for our customers. It's good for the overall industry. So now I want to pivot into the meat of the earnings power presentation and talk about our earnings potential. So before I do that, this is similarly based on the ramp that I just showed you in terms of megawatts and things like that. This is showing you, though, what full completion of Dorothy 2, Kati 1, and then 2 additional, we call them projects X and Y. That could be Rosa, that could be On, that could be Hetty, it could be any of those. Without being specific, we're using the economics of Kati 1 as a proxy for those and showing you what would our revenue and our adjusted EBITDA look like if we were to develop those projects on kind of the timeline that we expect. And you can see here very substantial growth. So we go from achieving our revenue in the second half of 2025. That's key. This first bar is not a full year number, but 21 on a second half basis to nearly 80 million next year, to 120 in 2027 and 130 plus in 2028. And you can see that the EBITDA has a similar and even higher growth rate on that, going from 5.2 million in the second half of this year all the way up to 55 million nearly in fiscal year 28. And it's important to note, this is using $55 hash price as a key assumption. So I'm now going to flip over. I'm going to show you what would things look like if hash price on average over this time period were to be $75. So again, with everything else the same, but the hash price changing, you can see that the revenues would go from nearly 29 million in the second half of this year all the way up to close to 170 million by 2028. And the consolidated adjusted EBITDA would go from about 12 million all the way up to just shy of 90 million in 2028. And again, the key difference here is an additional $20 of hash price. Same information, just a bit more detail. I'll talk about it, then I'll pause. You may want to review the numbers in detail to understand, but this should give you a better idea of the split by project. And you can look at, for example, how Sophie is projected to play out, and D1A, D1B, Dorothy 2, Kati, and those 2 Project X and Project Y that I talked about. And also there is demand response. So for our Texas-based projects, we are in the ERCOT demand response program that enables us to earn revenues by pledging some of the megawatts to be on short standby capability, which we're able to do with the flexibility of our Bitcoin hosting model. So again, you can see the strong increase in the numbers. You can see how the megawatts coming online, for example, I'll look at Project X. You can see, obviously, that would imply that it's coming on right at the end of 2026 and then fully on for 27 and 28. And similarly, Project Y is on for, let's say, a third of the year in 27 and then fully energized for 28 and so on and so forth. So hopefully this gives you a good idea. That's on the revenue side. And then you can also see site level EBITDA. So what is site level EBITDA? It is basically the revenues that come in on a fully consolidated project basis minus the costs, the variable and fixed costs that are direct at that site. It doesn't include any of the Soluna corporate overheads or anything like that. When you add those Soluna corporate overheads, you then get to consolidated adjusted EBITDA. And again, this is total on the projects as consolidated. Oh, by the way, keep in mind, these are non-GAAP financial measures. We have some explainers towards the end of the presentation to define how we look at these different terms, and you should review those if you have any questions on that. So again, this is $55 hash price. So flipping to this slide, this is still $55 hash price, but we wanted to show you when we have total consolidated adjusted EBITDA, we then have partners, Springlane, Navitas, and on Project X and Y, future potential partners. And we receive some of the money for our operations and maintenance margin and our admin fees to operate the project. So when you boil all that together, right, the total consolidated adjusted EBITDA, less the dollars that we distribute to our partners, but plus dollars that we receive as fees, is essentially what is the bottom line adjusted EBITDA for Soluna itself. So in this $55 hash price scenario, what you end up with is for the second half of this year, we're looking at approximately just shy of 500,000 of Soluna adjusted EBITDA, and then jumping up pretty substantially in the coming years. So in fiscal year 2026, with D2 fully on, and by the end of that year, Kati fully on, you can see we would generate about 6 million of Soluna adjusted EBITDA. And then with Project X and Y and full years of D2 and Kati and our existing SOFI D1A, D1B, we go to nearly 15 million in 2027 and over 20 million in 2028. Again, $55 hash price. So we've also shown the same two slides. This is for the $75 hash price. You can see substantial improvement in the EBITDA generated, as would make sense, more revenue for a similar cost and structure. So in this case, our site level EBITDA in 2028 builds all the way up to over $100 million. And again, on a Soluna equity basis, our adjusted EBITDA goes from nearly 4 million in the second half of this year. Again, that's if the average hash price for the remainder of the year were $75. This is approximately what we could generate, all the way up to $37 million in fiscal year 28. So I talked about some of these generically as I walk through, but just so you're familiar, these are some of the key assumptions that we used when modeling this. I hammered on the 55 and the 75. That's our base and upside case hash price assumptions. You can also see some of the assumptions on a project-by-project basis. At Dorothy 1A, we assume hash rate and efficiency improvements in 2026 as we turn over hosted customers, which is normal course. That's how we run our business, to get to more efficient machines. And we then expect those customer deals to be similar in economic performance to those that we are currently deploying at Dorothy 2. D1B, we have not modeled a refresh of the miner equipment. So there is some, as is normal with machines over time, some degradation in performance there. Kati 1, we're showing you initial energization late this year with 100% ramp up by the middle of next year, and a mix of different hosted contract models. Dorothy 2, we've already hit the initial energization, and by the end of the year, we'll be 100% ramped up. And we're expecting, you can see there, the contract terms to be about $70 per megawatt hour in revenues. And then our demand response revenues are basically an estimate based on recent pricing of megawatts that we can pledge there. And projects X and Y are assumed to be similar to the economics of Kati 1. And we have not shown you any AI revenue in these illustrations. That might be something that by next year, when we update this presentation, it would make sense to do. So hopefully that helped you learn a bit more about our current profitability. I think a key takeaway is how much of the profitability drops to Soluna, and gives you an idea of some of the assumptions that we are using to model these illustrative results, and some of the future potential earnings. And as we talk about investing in and owning our projects and why we want to do that and why that's accretive, hopefully this helps you to understand those economics and how we see those. As always, please connect with us, interact with us. We do a lot of content like this. We also answer questions in the Ask Me Anything series. We can field questions from you directly via our website, on X or LinkedIn, and we encourage you to follow us there. We like to communicate a lot of information, and please subscribe to our newsletter. And again, in the downloadable presentation, you'll find an appendix, and it'll walk you through various slides and information that is also in our investor presentation, which I encourage you to look at.